Have you ever chased passive income only to be disappointed when the cash flow didn't show up? It's a common pitfall, especially for high income earners who get lured in by internet gurus about the promise of quick cash and very fast cash flowing returns. So imagine instead of stressing over every maintenance call or every tenant turn, you were able to see your properties for what they truly are. Long-term wealth building machines. You're listening to the Real Estate Fast Pass, the podcast for the truly passive investor who wants to get into real estate without having to take a low-paying job in real estate. A low-paying job such as being a landlord, always having to check their spreadsheets for their maintenance calls, or having to do this on the weekends when you would prefer to be with your family. My name is Jimmy Vreeland. I'm your host. I'm the Main Street Patriot. With me, as always, is my producer, Jake. And Jake he's here to slow me down because I like to talk fast because I get excited about talking about real estate. Today on the show, we're going to dive into a tough but crucial question. Is the dream of immediate cash flow from real estate just a myth? And to break it all down, I'm going to share a scaled down version of a main stage presentation I gave last week at one of our live events. In this episode, you can look forward to learning 3 key things. One is, why is cash flow the least important of all the 4 pillars of wealth building? How most people misunderstand their real investment timeline, and why investing for quick cash, if they only want the short-term win, they don't get the real win that they're seeking in real estate, and they quit way too early. We're even going to uncover some surprising things about your maintenance bills, that they might be the smartest reinvestment that you're making. So if you're ready to stop chasing short-term cash and start building long-term wealth with real estate, then stick around for this episode of Real Estate Fast Pass. What's up? Welcome to the Real Estate Fast Pass podcast, the only podcast, I think, in real estate for the truly passive investor who wants to get into real estate fast, and they don't want to deal with all the contractors, all the property managers, all the numbers. They want to get a fast pass from taking on a low-paying job in real estate, which every other podcast, every other guru is telling you to do. And with me is my producer, Jake. How you doing?
Good, Jimmy. Good to be here with you on the Real Estate Fast Pass podcast.
So if you're a loyal listener, you might be thinking, wait, another name change? Yeah, it's another name change. Sorry, not sorry. You know, we had Main Street Patriot, which I learned is not a great podcast title, is a cool nickname. And then we had Done For You Real Estate, which is cool. But then I was at a mastermind 2 weeks ago going through our program, and everybody in the room was like, wait a minute. Real Estate Fast Pass. That's the name of the podcast.
Yeah, it's like as soon as you opened up, the box to hey, let's go simple, that one became very clear, which is great. I think
it's much simpler than Done For You Real Estate. It's a straight up, this is Real Estate Fast Pass. If you work with Vreeland Capital, it's like going to Disneyland. If you're a high income earner and you go to Disneyland and don't buy the Fast Pass, you're just cheap. Most people in our program, they have gone to one of the Disney theme parks and they do buy the Fast Pass. Why? Because they can, and because their time is more valuable to them than their cash. Same thing with real estate. What's more valuable to you? Your time or your cash?
Exactly. Yeah, you're just wasting time by waiting in line.
So, Jake, what I want to share with everybody today is a scaled down presentation of what I gave to our audience at the Cash Flow Heaven events. Every once a year, every summer, generally in June, we have a bus tour we call the Cash Flow Heaven event, and we'll probably change the name of it after this talk. But we always have buyers come in. We do a bus tour. We go to a Cardinals game. We have a ton of fun. And I kind of want to share as a podcast the great majority of the presentation I gave at Cash Flow Heaven Tour. Sound good?
Sounds awesome.
And so what I titled the presentation, Destroying the Cash Flow Myth.
Okay.
And so the people I have seen the most unhappy in real estate are people who expect immediate cash flow. And so I started off the presentation being like, look, you guys are new. I want to start your expectations out correctly. And it's that real estate is going to create a ton of wealth for you, but it is not going to create a ton of cash flow really fast. And even when interest rates were low, and even when prices were cheaper, I'm not convinced that it's ever created enough cash for high income earners to replace all their income, because I associate with a bunch of higher income earners in the real estate space who are really wealthy. They have a high net worth and they have a bunch of liquidity, but they all still work. That's why they're masterminding with me.
Sure.
Because this weird thing happens. It's like, well, you get productive in real estate and you see how to make money. You're like, why would I ever quit? And I believe it's in every other trade. And so my goal is to really kind of dispel this myth. And that's what we're going to talk about on the podcast today.
I love it.
And so I think there's a complete cognitive disconnect when it comes to real estate investing. I want to figure out, I have a theory on where this cash flow myth was created. And so we're going to go through that today. But play along with me here, Jake.
All right.
When you invest in a publicly traded company, when do they give out cash flow?
I mean, I don't know if it's like predetermined, but it seems like it's kind of up to their discretion to some extent.
Yeah. And so when you invest in a publicly traded company, if you're an investor, when do you expect to receive a dividend?
When they feel like they got to keep the investors happy, then they issue some dividends. But other than
The
that,
short answer is they typically reinvest up to 60% of their earnings. And so the short answer is you wait 30 years for publicly traded companies.
damn, it's 30 years.
I mean, if you
Wow.
want to, yeah, I'm sure there's some. Name a really high dividend paying stock right now in today's economy.
There's not a lot of them. I mean, as far as I know. And
Right.
again, it's like they're reinvesting constantly, and then like when they start to see investors, they give them like a little taste of like the dividend.
Great majority of the cash is going to reinvestment, right? Startups. When can you expect to see cash flow from a startup?
When they exit.
Exactly. When there's a waterfall event, there's not even an expectation of cash flow. Now, there's a great book called Profit First. You're a small business owner.
Yeah.
And are you aware that only 30% of business owners take a regular paycheck?
Yes.
It's part of the struggle of owning a small business. It takes fiscal discipline to actually extract cash from your business. And the first 3 years of me and my business, it took me a long time before I could start taking consistent paychecks.
Yeah.
And so, once again, small business owners, low expectation of cash flow. 1K, when's the expectation of cash flow?
When you retire,
30 years.
30 years.
Now,
Okay.
here was something interesting. As I was preparing this talk, I had my wife send me my kids' sports bill for May. And it was
Okay.
around $1,500. So we have 4 kids.
Yeah.
We're heavily involved in sports. My wife gets a bill for sports. What does she do?
She pays it.
Right. But now if my property manager, Rhonda, sends me a $1,500 bill, what do I do?
You pay it.
No, I first complain to Rhonda and say, how could this happen? This would never happen to me. This is killing my cash flow.
Yes. Yep. Yeah. No. Exactly. We don't want to pay those maintenance expenses.
Also, when I was preparing this talk, from our website guy, I got a bill, $2,500 for my website, and I paid it. I didn't even ask, right?
Mm-hmm.
But if Rhonda sent me a $2,500 bill, I'd be like, what is this? It's killing my cash flow. No way I'll pay it, right? So why am I so easily and willing to reinvest in my children's sports, and I'm so willing to reinvest in my website, but I don't want to reinvest in my properties, where I hold the majority of my wealth?
That's fascinating. Okay, I'm with you. Like, where does this come from?
There's a cognitive disconnect here, right?
Okay.
And so I think it's because of the gurus. I think it's because Rich Dad, Poor Dad. It's this ideal that you're financially free when your cash flow is greater than your expenses.
Yeah. Okay. So, yeah, the gurus. So, like, the Cody Spurbers of the world, right? Who are just saying this message about easy money,
Yeah.
free money, basically.
Yeah, it just doesn't exist. And so, we have a new summer intern, Ryan, and he goes to Notre Dame. He's got a 4.0. He's a sharp kid, right?
Yeah.
And I was talking to him about this as I'm preparing it. And he's like, well, what do you mean? What's the definition of wealth? And this kid wants to get into big hedge funds, macroeconomic stuff.
Okay.
And I'm like, well, the guru would say once your cash flow equals your expenses, you're rich. And then he's like, well, Jimmy, I would just to get that equation, I'd keep my expenses really low, but I don't think I'd be considered wealthy or rich. And so, like, cash flow has a very low determinant and your actual wealth.
Mm-hmm.
Now, I get what Kiyosaki's saying. And then one of my favorite Jordan Peterson quotes is, it's better be walking with the wrong map than not walking at all. And so
Yeah.
I lived this Rich Dad, Poor Dad map. I walked,
Right.
and this
Right.
map did wonders for me.
Right.
But it didn't get me, my cash flow is greater than my expenses. Because the more productive I started getting, and the more I started getting paid for active income, and the more I kept saving, the more my expenses went up. And I'm someone you would consider a somewhat frugal spender. But I'm not going to save every dollar. I bet you I save more than 50% of what I make. But even when I put that control on myself, my expenses kept going up, not irrationally. I
Sure.
would say, you know what? Since we've done better in business, my expenses have gone up in my children's athletics and my children's education and better vacation.
I was gonna say you're an aggressive guy. You want to move fast, and part of that means like not being afraid to invest, like you were putting it, in all those areas.
Yeah, but so I'm just saying, like, do you know what the FIRE method is? It's like this old school, like, I'm going to keep my expenses low as possible, get cash flowing assets. I'm talking like living at like bare subsistence level,
Okay.
just so you don't have to work. And we've said it a million times on this podcast.
Mm-hmm.
Like, okay, cool. You're going to sit out the most abundant economy and the greatest economic machine in human history because you don't want to work. Like, I'm not going to build a program for that. I'm not going to work with people like that. It's too scarcity minded.
Right. Yeah. Or put another way, it's like, well, what are you waiting for? Like the other side of the spectrum, so to speak, is well, I'm going to work really intensely and save so that, when I'm 70 and retired, then I can finally start spending some money, but you can't even enjoy it anymore because your body's breaking down and whatever else, right?
So there's got to be this healthy balance. So I think that cognitive disconnect comes from two. It comes from Rich Dad, Poor Dad. I have a lot of respect for Mr. Kiyosaki. I hope he doesn't think I'm talking smack if he hears this, but I just don't think the cash flow. And then I think if we were speaking to him, he'd be like, oh yeah, cash flow in 10 years, not right away. And so maybe it isn't even his myth. But then I think when people hear cash flow, they hear right away. And so I think we're all caught in this tug of war of we all want to grow and expand, and we all want more. Like on John D. Rockefeller's richest man in human history. Right. He's 90 years old. And a reporter asked him, he's like, when will enough be enough, Mr. Rockefeller? And he puts up his old cranky 90-year-old finger, and he's like, every day, I just want $1 more.
$1 more.
And then,
damn,
I understand that.
Yeah.
Feel that? Do you feel that?
For sure, yeah. I mean, I think we're wired for growth. We're wired for more, whatever more is.
And so that's never going to go away. And then there's another part of us that want to be sitting on a beach all the time. And so there's this great tug of war between how can I get more money, but then sit on the beach. My experience has said that you can always get more cash, become more productive, but you're not going to sit on a beach. And then
You're a big fan of paradoxes, and you're talking about the passive income paradox a little bit. Is this a paradox where both these truths are compatible, or like
no.
how do you analyze this one?
No, I think it's part of the human condition.
Okay.
Like, let's go biblical. Even before the fall, the expectation was that Adam was going to tend the garden.
Right.
I mean, that was in paradise, that there were still things to do.
Yeah, we just didn't have this unwillingness to do it.
Yeah, so I think the desire to sit on the beach, I don't think it's beneficial. I don't think it's good.
Okay.
And then I think about it. Let's say I go on vacation with the kids, and like Susie's a little beach timed out, but I'm like beach-wise, family-wise, we're kind of done with it. We want more active vacations. Because 2 days on the beach, I'm done. I'm going nuts. And then if I'm having margaritas, I'm angry on the third day because I'm hungover. And I'm cranky.
Yeah. Bored, angry, cranky.
And cranky.
After a couple days on the beach.
So everybody's like, I want to live on this beach and all this stuff. And no, they don't. I think it's a very limited part of the population who could actually do it. Now, there is a economic term for this, what we're discussing, this tug of war.
Okay.
And it's from Ludwig, we're going to geek out here, Ludwig von Mises. He founded the Austrian School of Economics, but he referred to this as the disutility of labor. And so, sure, labor can stink. And I love my job. I love my business. But there's days when I'm like, I wake up and I don't want to do this. I don't want to do this meeting. Mm-hmm. But I already made commitments, so I'm going to do it, right? Mm-hmm. That's part of the human condition. And so von Mises said labor involves disutility or unpleasantness, and that people choose to work because they find the benefits outweigh the cost. And so I think it's part of the human condition that you're always going to have to labor, and you do it because the benefits outweigh the cost.
Yeah. Yeah. And I'm thinking about things that I find unpleasant. And most of the time when I just sort of like embrace that and push through, kind of see it as a challenge and push through, that oftentimes I get a lot of pleasure actually from having accomplished that thing that I found unpleasant. And so is that what he's talking about? Like the benefits in the long term outweigh the temporary costs? Or is he okay?
Yeah, it's the ability to sacrifice and the ability to work.
Yeah.
And it doesn't have to always come back as like a ton of cash. But like as a parent, there's plenty of stuff I see my wife not get paid for. But she's becoming a better person, becoming a better mother. And like she does it, probably starts out a sense of duty, but then she gets the benefit of their children loving her, me loving her for doing that.
Sure. Okay. So disutility of labor is in fact like okay. So like when we think about like utilitarianism, you're talking about like, hey, well, this in and of itself is useful to me.
Yeah, utility of labor would be, hey, I loved every moment of this. It was completely useful to me.
Right, right,
But the disutility is like, hey, obviously there's going to be stuff I'm going to sacrifice and not want to do.
right.
And so where I think that now we're going to go back to real estate gurus.
Yeah.
I think real estate gurus have manipulated this part of the human condition.
Accredited investors, if you're looking for quality real estate to put in your portfolio that is pushing 30 to 40% in annual returns, well, I'm glad you're watching this ad because I bring my investors about 400 of those deals every year, and all the due diligence is already completed. We also have all the lending lined up, and we have the construction and property management already set and ready to go. And it's all in-house, all done start to finish by my team. All you got to do is review the deal, write the check, show up at closing, and you're done. And the best part is there's no equity splits. You own the asset 100%. My team gets paid to do the things you were already going to pay for anyway, like having someone find the deal, fix up the deal, and manage the house for the long term or offload the deal for a flip. So if you want to invest in real estate and you want to build a portfolio on autopilot, or maybe just flip a few houses with a vertically integrated team doing all the work for you A to Z, click the link. There's more information on how this works on the next page and the option to book a call with us to discuss working together.
Created a myth that you can get rid of the disutility of labor, which once again is part of the human condition.
Right.
And so I don't think it's healthy. I don't think it's right. And then it's just on the surface of it. I just went through 4 or 5 investment classes where people have a 30-year timeline for a return in cash, a cash return, which is so hard. And I'm speaking as a small business owner here. To extract cash out of my business, one of the hardest things I've ever done. And then to do it consistently.
Right.
And now we've been blessed and like we extract it consistently, but it is not easy to do. And then quite frankly, 90% of small business owners aren't able to do it.
Right.
And now let's go back to a little bit of gratitude, Jake. What is the best thing about a paycheck?
Guaranteed cash.
That's your cash flow, bro. And so when you got these gurus saying like sniffing, putting their nose up in the air at a paycheck, right? I can't stand it.
Yeah.
It really pisses me off.
Yeah.
Because guess what? At the end of every year, I turn in a W-2, and guess what it is? It's a paycheck from a business I own.
Sure. Okay.
It's still the same thing. It's still a paycheck.
Right.
And the whole glory of the small business owner on Instagram, man, like it was a 36 months battle to get that paycheck. And so I really don't like it when the gurus are talking smack about paychecks.
Yeah. Yeah. The W-2, the JOB, just over broke, kind of slang that you hear out there.
Yeah. So let's go get more broker and go get in more debt just so we look cool on Instagram.
Well, especially for the high income earner.
Yeah.
Like, hey, there's nothing wrong with this paycheck. That's awesome.
It's the best. It's your cash flow for your active income. Like I would much rather rely on my skill set than a 1,000 square foot house to cover my monthly expenses. But now these 1,000 square foot homes, it sounds like I'm talking smack about, they also create a ton of wealth.
Right.
And so they do create cash flow in 10 years.
In 10 years. Okay.
And then here's the sad reality, hopefully, of anybody listening to this podcast of me. And do you know what it is when it comes to cash flow?
No.
The people who work with us, they all make too much money for cash flow to ever make a difference to them under 10 years. I can't tell you how many doctors, I've talked about this before, doctors, lawyers, who are like, I want to buy real estate and replace my income. I'm like, impossible. No way. Not within 10 years. And where I think the guru would be like, oh yeah, we can definitely do that.
Yeah. They haven't really sat down to do the math, either of those two parties.
Right.
Well, the gurus, for example.
Yeah, I can torture the data long enough, it'll tell you anything. And so, sure, I'm sure they can do math to say, I mean, when I originally did the math, I needed $5,000 to live a subsistence livings with 4 kids. And so I was calculating $500 a month cash flow. And so what does that mean? I needed 10 houses? Yeah. But that's not how it worked out. Especially now, I think those houses cash flow $500 now, but I've owned them for 10 years.
Right.
And so if cash flow isn't why people should invest, why has real estate been the greatest wealth producer of all time? Because it's the other 3 pillars. Cash flow is simply the cherry on top. Now, let me work you through this. Let's work through, I'm going to kind of shift gears a little bit. We're going to talk about the top net worth tiers in this country. So to be in the top 1% of net worth in this country,
Okay.
you have to have a net worth of 11 million. To be in the top 2, you have to have a net worth of 2.7. To be in the top 5%, you have to have a net worth of 1.2. So remember those numbers: 11 million, 2.7, and 1.2, right?
Okay. All right.
Okay. And I'm using this to answer the question, why has real estate been the greatest wealth producer of all time?
Right.
And it's because you win in 4 ways. Now let's just take a case study. A house I sold in Florissant a year ago, right?
Okay.
So the appraised value when I sold this house, it was worth 157. If you assume appreciation of 5% a year for the next 10 years, 10 years from now, the house is going to be worth 256. And also rent's going to go up 5% a year. Year 1 rent's 1430. Year 10 rent's going to be 2200. And then here's the magic. The mortgage payment on a house is 735. You know what the mortgage is going to be 10 years from now?
735.
735. So same cost, but the house is appreciating and the rent's going up. That's why it creates wealth.
Yep.
The cash flow gap actually opens up. And so here's the 4-pillar return on this house. And you can find these assets all over the Midwest. But you can have an appreciation of $99,000. You're going to do an equity pay down of $20,000. You're going to have a tax savings of $16,000. This is over 10 years. And then finally, only counting cash flow year 10, which will be $9,000. That's $146,000 return.
Wow.
On
In 10 years.
Yes, on a $31,000 down payment. That's a 464% return. And 70%
Dang, and so
of that is going to be from appreciation.
Yeah. Cash flow is only a fraction of it.
Yes. It's close to negligible. Your real advantage is going to come from appreciation, the tenant paying the mortgage down, then finally, and then tax advantages, and then finally cash flow.
Mm-hmm.
And so let's say you do this 20 times, which is what I recommend in the Real Estate Fast Pass. Those houses are going to appreciate $1.9 million. The tenants are going to pay the mortgages down $428,000. You'll have a $300,000 tax savings. And then year 10 cash flow on those assets should be around 180 grand a year.
Mm-hmm.
So the total return year 10 is $2.9 million. To be in the 2% of net worth, you got to get to 2.7. So passively, and with a Real Estate Fast Pass, you can do this passively. You are now in the top 2% of net worth in this country. Not bad.
Not bad at all. Dang.
So now it comes to the question, why do the majority of people not make it to the 20 houses? Any ideas?
Getting distracted, cash flow issues.
I believe it's because they're investing for cash flow and they lose their mind whenever they see any maintenance or make-readies. Now, occasionally they run out of cash, but that's generally not a problem because we show people pretty creative ways to extend their capital.
Yeah.
But
I've heard about some of those.
if you're investing for cash flow, you lose your mind with maintenance and make-readies. And so then you quit. And then you are essentially, you're stepping over dollars for pennies.
Yeah.
And so the way I'm telling people, how do you think people should view their maintenance and make-readies?
As an investment. It's like the cost of doing business, just like sending your kids to sports practice.
Well, yeah, let's go back to the beginning of the podcast. Most publicly traded companies take their earnings and reinvest, right? Startups take all their earnings and reinvest.
Mm-hmm.
Now, where real estate has another advantage is you're taking your residence payments and reinvesting.
Yeah.
So to expect to extract it all out of your portfolio early, I think is unrealistic. And so I look at my maintenance and make-readies as resident reinvestment plans.
Sure. Dang. And then you can really be proud of that property that, providing a good home to a good family, and rather than letting that real estate actually deteriorate and not be worth what it should be worth in 10 years or 20 years.
One of my favorite Instagram videos I was visiting Rome with Susie, and we walked into like the ruins from ancient Rome, right?
Yeah.
And I'm like, hey, for all you whiners who don't want to do maintenance or make-readies on your property, here's what you get. I was showing some 2,000-year-old palace that was just in ruins.
Yep, that'll do it.
To kind of put a bow on this podcast, like if you're investing for cash flow, one, it doesn't make a lot of sense if you're a high income earner because you already have cash flow. What you have then is a tax problem, and you have really an inflation hedge problem. You need to be able to build wealth. And so those people investing for just cash flow, they're tripping over dollars to pick up pennies. It just, to me, I look at the math It doesn't make any sense.
Yeah, I mean, on that example you gave, was it over $300,000 worth of tax savings?
Yes.
And that was twice the potential cash flow.
Yeah.
That alone, just like, hey, well, what should I be focused on?
Exactly. And then, we've worked with people who they bought 16 houses with me. Their 4-pillar return in 5 years is $1 million, and they only invested $300,000. I got several people who have bought over 10 houses with me. They're getting this level of return.
Yeah.
Oh, you know what? We'll have them on the podcast so they can talk.
There you go. Yeah. Hear from their mouths themselves.
All right. Well, I think I've done a good job beating this dead horse. Are you ready to wrap this one up?
Let's do it.
All right, gang. So if you're interested in starting a passive rental portfolio and you want to get the real estate fast pass, please visit our website. What's the landing page, Jake?
www.jimmyvreeland.com/get-started-in-real-estate.
And so we appreciate you listening to the podcast. If you already have a fast pass, thank you for buying the fast pass. Thank you for being in the game with us. And if you've gotten value from this podcast, please like, share, and subscribe. And leave a review. I'd really appreciate it. All right. Talk to you guys later.
Peace.